So, have you ever wondered if you could, I don't know, literally peek into the future of the stock market? Imagine knowing exactly how a stock is going to perform days or maybe even weeks before anyone can actually buy a single official share. Sounds pretty much like a superpower, right? Well, in certain hidden corners of the financial world, investors are out there attempting to do exactly that every single day. To put this into perspective, just picture this number: 119%. According to data from IPO Watch, that was the expected listing gain for a company called Millworks Technologies. That means before this company even had its official public debut, the underground hype was suggesting its share price would instantly more than double. It's an absolutely staggering figure, and it perfectly captures the extreme fever pitch anticipation that builds up before a company officially hits the market. So, welcome to this explainer. Today, we're diving headfirst into the alluring, highly secretive, and honestly wildly unpredictable world of the IPO gray market. We are going to figure out exactly how these pre-market predictions are made, untangle some of the super unique slang that traders use, and most importantly, we're going to see whether this unofficial crystal ball can actually be trusted. Here's the quick roadmap for how we're going to break this all down today. First, decoding the gray market. Second, co-stack and subject to SATA. Third, calculating your estimated gains. Fourth, hype versus actual performance. And finally, the reality check. All right, let's jump right into part one, decoding the gray market. The whole heartbeat of this underground system is something called the Gray Market Premium, or GMP for short. Basically, this is the totally unofficial price difference between an IPO's official issue price and what the street thinks it's going to list at. This trading happens entirely over the counter, which means it is completely outside the bounds of any official stock exchange. You can kind of think of GMP as a real-time, unofficial barometer for investor sentiment. If the GMP is soaring, investors are super bullish. If it's flat or negative, they are definitely bearish. Now, you might be wondering what actually drives these premium numbers up or down. Well, it doesn't just run on magic. Just like the regular stock market, the gray market relies on three main pillars. First up, company fundamentals, strong financials and growth potential. Second, broader market conditions, like is the overall market feeling optimistic or gloomy right now? And third, just classic supply and demand dynamics. How many shares are out there versus how intense the investor interest is? When you get massive demand meeting tiny supply, that GMP just skyrockets. Moving right along to part two, cost stack and subject to SATA. Okay, let's translate some of this street jargon, starting with the co-stack rate. This one is actually a really fascinating concept. The co-stack rate is a fixed premium that an investor can get by selling their entire IPO application to a buyer outside the market. And here's the real kicker. This fixed profit applies whether or not the original investor actually gets any shares in the official IPO lottery. It's basically a way to lock in a guaranteed profit early, passing all the future listing risk, and the potential massive reward, of course, straight over to the buyer. Now, contrast that with our next term, subject to SATA. As you can probably guess from the name, this is a conditional deal. It's a premium amount you agree on for an IPO application, but, and this is a huge but, it only remains valid if you actually receive a firm allotment of shares. If the dreaded IPO lottery system totally blanks you and you don't get any shares, the whole SATA or deal is just completely canceled. So no fixed, guaranteed profit here unless you actually win the shares. Which brings us to part three, calculating your estimated gains. So how do everyday traders actually use this unofficial crystal ball? The math is incredibly straightforward. Literally just three quick steps. Step one, identify the official IPO issue price. That's just what the company is asking for. Step two, check the current gray market premium, which is usually circulating through local broker rumors. And step three, just add them together. The total gives you your estimated listing price. Let's look at a concrete example to really nail this down. Say a company sets its official IPO issue price at 100 rupees. The hype is building up, and local brokers are trading it with a gray market premium of 20 rupees. You literally just add the 100 rupee issue price to that 20 rupee GMP, giving you an estimated listing price of 120 rupees. Everyday investors use this exact simple equation to guess where a stock is going to open, which helps them decide if applying for the IPO is actually worth tying up their cash. All right, on to part four, hype versus actual performance. Now it's time to ask the million-dollar question. Does this actually work? Let's check out some hard performance data from IPO Watch. Take the Kusamgar IPO as a prime example. The official issue price was 419 rupees. Meanwhile, the gray market was absolutely buzzing with a premium of 161 rupees, which brought the GMT estimated listing price up to a lofty 580 rupees. When it finally hit the actual market, it listed at 569 rupees. The gray market was incredibly close. It predicted a massive jump, and well, a massive jump happened. So, while it wasn't down to the penny perfect, it acted as a surprisingly excellent barometer of sentiment. But, and you knew there was a but coming, the gray market is a classic double-edged sword. Take a listen to this real comment left on the IPO Watch platform by a retail investor named Tarun Basu. He wrote, "I made huge loss on Tata Capital. I bought from GM at highest premium. Unfortunately listed in the market 68% down from my buying price." That right there is the harsh reality. Sometimes a sky-high gray market premium just means you're overpaying for hype. And when the official market actually takes over, reality can bite hard. I mean, a 68% loss is devastating. So you gotta wonder, why do everyday people even risk it? Honestly, a huge part of this underground market is fueled by sheer frustration. If you look at user complaints, the official IPO allotment system often feels exactly like playing the lottery. You can tie up your money applying for dozens of promising IPOs and get absolutely nothing to show for it. That intense frustration of missing out on official gains is exactly what drives people into the gray market, hoping to secure some kind of profit through co-stack rates or by buying up high-premium applications. And that leads us perfectly into our final section, Part 5, the reality check. Okay, time to pull the rug out just a little bit because there are some really vital facts you need to take away from this explainer. First off, gray market transactions are entirely unofficial. There is absolutely no exchange backing you up. It relies 100% on blind trust between local brokers. Second, and this is crucial, trading in the gray market is actually illegal. The platforms that track these numbers explicitly state that GMP is for educational and informational purposes only. You should never ever apply for an IPO based solely on a high gray market premium. Now, the regulators are definitely aware of this Wild West environment. If we look at the timeline, in early 2025, SEBI chairperson Madhabi Puri Bush announced that the market regulator is actually looking to develop an official when-listed platform. This signals a direct shift from the totally unregulated shadows of pre-2025 trading into a much more formalized future, basically dragging this pre-listing excitement out into the broad daylight. And honestly, this shift is a massive game changer. Right now, today's gray market is unofficial, illegal, unregulated, and relies entirely on you trusting a broker not to run off with your cash. You literally have zero recourse if things go south. The proposed when-listed platform, on the other hand, promises to be official, regulated, and transparent. It would effectively limit all that dark trading and ensure genuine, fair price discovery for everyone, safely capturing that pre-IPO excitement without the sketchy back alley vibes. So, as we wrap up today's explainer, I want to leave you with a crucial question to mull over before your next big move. We've seen how human excitement can dramatically inflate a stock's perceived value before day one even happens. So ask yourself this: when you're eyeing that next big upcoming IPO, are you truly investing in a company's solid fundamentals, or are you just buying into the unregulated hype? Keep that in mind, stay focused, and happy learning.